Hello, class. So, my name is Kiana Howell, and we are Group 2. We will be discussing the statement of cash flows and how it relates to our case, Justified Wages.
I'm Laceptra Campbell.
And I am Desmond Paul. And we have a few learning objectives that we would like to cover during our presentation. We would like to gain an understanding of the purpose of the statement of cash flows, to understand how the components of the statement of cash flow work, differentiate and understand the components of the statement of cash flows, review the justified wages in its relation to the statement of cash flows, and to identify the classifications related to the case. So before we get started, we have a pre-assessment that we would like you guys to sit and think about for a few minutes to really get a gist of what we are talking about for this presentation. So we just have a few questions that we would like you to think about before we get more in depth with our presentation. So our first question for our pre-assessment is, what is the statement of cash flows? What are the components of the statement of cash flows? What are the accounting differences between GAAP and IFRS? What is the difference between indirect method and gross method? And what is the difference between net cash flows and gross cash flows? So, getting a little bit in deeper with the statement of cash flows, we have the purpose of the statement of cash flows. And so the purpose of the statement of cash flows is basically to summarize the amount of cash and cash equivalents going in and out of the company. And it also allows the shareholders to understand the company, how it's moving, where its money is going to, and how it's being spent. So to differentiate the two between GAAP and IFRS, we want to give you guys insight on the difference between how the statement of cash flow is between the United States GAAP and the IFRS. So some difference points that we pointed out is the interest, dividends, and taxes. So for the interest side on GAAP, interest is received or paid as is classified of operating activities, and the dividends received are also classified as operating activities. The difference is dividends paid are classified as financing activities for the U.S. GAAP, and for interest on the IFRS, this dividends received or paid are classified as operating, investing, or financing, and interest paid and interest and dividends received are usually classified in operating cash flows by a financial institution. And as we go a little bit more in depth with the taxes, we see that we can also point out that with GAAP, cash flows related to income taxes are generally classified as operating activities. And for the IFRS, cash flows related to income taxes are classified as operating activities unless they can be specifically identified within financing or investing. So as you see or look very closely to the pre-assessment, we are going over these questions to make sure you guys get a better understanding. So right there we just clarified GAAP versus IFRS, and we also went over the purpose of the statement of cash flows. So next we will have the measurements of cash flows presented by Kiana.
Thank you, Desmond. So, as Desmond stated, we'll be discussing the measurement of the cash flows. Just to get started, first we will discuss the difference between cash and cash equivalents. When it comes to the statement of cash flows, you're going to have both recorded on the statement of cash flows. Therefore, we need to know the difference. Cash is essentially currency. We all understand what cash is. It's a physical thing. Sometimes it's not physical, but we know what cash is. Now, cash equivalents is a little more delicate. Cash equivalents have to be high in liquidity. Like an investment, something that you can easily liquidate and turn into cash. So to further understand what the difference between cash and cash equivalents is, we will go to our codification, FASB 230-10-20. So here we can get a better understanding of what FASB says that cash and cash equivalents are. Cash, as FASB says, are consistent with common usage. Cash includes not only currency on hand, but demand deposits with banks or other financial institutions. So like I said before, cash is a physical thing, but it also can be more of a material thing, not really physical. Cash also includes other kinds of accounts. These are like checking accounts, saving accounts, deposit accounts, things of that nature. And we also have cash equivalents, which you can see are short-term, highly liquid, like I said before. They are also ready, available to convert to cash, which is the most important thing, and they're also very near to maturity. Next, we will talk about the difference between the direct and the indirect method. Now, the difference between these two are going to be in relation to operating activities. These determine what is included in your operating activities. So under the direct method, you're going to have all items that directly affect your organization. For instance, you have cash collected from customers, you have cash paid to employees, you have cash paid to suppliers, your interest paid, and other things of that nature. Under your indirect method, these are going to have an effect on your net income and loss that are reported by the company in the income statement. For these accounts, you're going to have depreciation and amortization. We're going to have gains and losses, changes in receivables, inventory, payables, and things of that nature. So for the crux of this presentation, we're going to discuss the difference between gross and net cash flows. So before I really go in depth of what gross and net cash flows are, we're going to go to the codification, 230-1045-7. So as it states here, it says that generally information about gross amounts for cash receipts and cash payments during a period for a organization are usually more important. Gross literally just pertains to cash. These are maybe you make a payment to your employer, and they made a purchase of stocks, and you're repaying them for their stocks. So that would be considered gross because it's cash. And then under your net amounts, these are things that are cash equivalents. So that's why it was so important for us to know the difference between cash and cash equivalents, because gross net flows pertain to your cash, and net cash flows pertain to your cash equivalents. Again, reinstating the importance of the difference. Next, we will go into the classifications of the statements by Leceptra.
Alrighty, so for this portion of the presentation, we're going to basically discuss the different components that make up the statement of cash flows. I'm sure you guys remember from back in probably principles or intermediate that there are 3 parts of statement of cash flows, or 3 major parts. So that would include our financing activities, operating activities, and investing activities. Alright, so first we're going to discuss the operating activities. So operating activities are defined as the daily activities of a company involved in producing and selling its product, generating revenues, as well as general administrative and maintenance activities. Before we go deeper into that, though, we should also talk about why are they even separated. So there are 3 components because companies can generate and use cash in several different ways, such as making an investment or even paying for the bills. So there's another way you can also define operating activities, just in layman's terms. You would just say it represents the amount of cash that the company brings in from its regular business activities. So some of those activities would include production of sales, delivery of products, and collecting money from customers that purchase a product or service. Some of the accounts that will be listed under the section will be accounts receivable, accounts payable, amortization, depreciation, and other items. as Kiana discussed earlier, there are two methods that are used when using the cash flows for operating activities. There are two methods that you can use to record them. So the first one will be the indirect method again. This begins with net income for the income statement, then it adds back the non-cash items to arrive at a cash basis figure. And then the direct method will track all the transactions in a period on a cash basis and use actual cash inflows and outflows on the cash flow statement. Alright, and then the next portion of the statement of cash flows that we'll discuss is investing activities. So investing activities report how much cash has been generated or spent from various investment related activities in a specific period. Investing activities would include purchases of physical assets, investment securities, or to sell securities or assets. I'm pretty sure we all know what investing is. All right, and there are different ways that you can have flows of cash for investing activities. You either have cash inflows or outflows. So cash inflows would come from selling the fixed assets, making investments or intangible assets when you sell those. And then your cash outflows from investing activities will come from buying fixed assets, buying investments, or intangible assets. Alright, so the last activity that we'll discuss will be financing activities. Financing activities show the cash flows, shows the net flows of cash are used to fund the company. It provides investors with insight into a company's financial strength and how well a company's capital structure is managed. This includes transactions involving debt, equity, and dividends, and it basically just measures the movement of cash between a firm and its owners, investors, and its creditors. So there are also ways that cash flows for financing activities. We also have cash inflows and outflows. So cash inflows for financial activities will come from issuing debt and equity securities. And cash outflows will come from repaying dividends, debt, and purchasing treasury stock. So we did find a formula that we can use to help calculate our finance activity amount that we would put onto our statement of cash flows. So that equals CFF, which is financial cash flows, basically, equals CED minus CD plus RP. So CED is your cash inflows from issuing equity or debt. CD is your cash paid as dividends, and RP equals repurchase of debt and equity. And so how we could apply the formula would basically be, first, if you repurchase stock and it's $1 million, that will be considered cash outflow. If you have proceeds from long-term debt, $3 million, that would be considered cash inflow. Payments to long-term debt, $500,000, that's a cash outflow. Payments of dividends, $400,000 is a cash outflow. So basically, whenever you are spending money, it's a cash outflow. Whenever you are receiving money, it's inflow. So just to calculate it, you would take your inflow minus your sum of your outflows, and you should get your balance for what would be in the financing activity section of the statement of cash flows, which in our case is $1,900,000. All right, and we also want to just show you an example of a statement of cash flows. So we looked at Target, and we'll pull it up for you guys. All right, so Target has their statement of cash flows for the last 4 years. So you have 2017, 18, 19, and 20, and obviously we're in 2020 now. And I just wanted to show you that they have, just like how we just discussed, a real world example so you can see how it's applied. So like I said, the first section will be the statement of cash flows will be the operating activity. So here this line says cash provided by operations, and then the next line they listed is investing activities. So here they listed a negative 2.944 for their investing activities for the year, and if you can see here in the parentheses they put required for or provided by. So required for is basically what they had to spend to get for those activities. And then their last line will be cash required for finance activities. So this just goes to show you guys basically the different components that are on the statement of cash flows, and this is a real world example so you can see how it would apply when you are an accountant in corporate America. So the next portion of the presentation will be talk about the case.
So the case that we had was justified wages. And before we go in depth, we must go over the facts of the case. We have taken out the most important statements of the case, so hopefully you all have read to fill in the gaps. If you have not read the case, please pause the video and take a few minutes to read the case that is located in the in-class link in Blackboard. It is called Justified Wages. So to continue, as stated before, we have taken out the most important pieces of the case, which are justified wages securing financing of $40 million from WTD for $30 million. For $30 million issues of Series E stock, $10 million for the sale of shares of common stock, and $10 million repurchase of common stock from current employees, and 2.6, which is considered to be the in excess of fair value. Also important, justified wages in all situations was the acting principal. So really the major question that we have to answer is, how should this be presented in the statement of cash flows? So first we have to determine if the money received is going to be gross or cash. So the first question says, should the 10 million paid to employees and $10 million received from WTD be presented gross or net in the company's statement of cash flows? So to determine the answer to this question, we must go to the codification listed. So the codification we have is ASC 230-1045-7. So this is just letting us know the difference between gross and cash flows, which we generally talked about before. So this says that generally information about the gross amounts of cash receipts and cash payments during a period is more relevant than information about the net amounts of cash receipts and payments. However, the net amount of related receipts and payments provides sufficient information not only for cash equivalents, but also for certain other classes of cash flows that are specified in later codifications. So, going back to the question, which is the 10 million paid to employees and 10 million received considered gross or net? We have to keep in mind that justified wages is the acting principal in both of the transactions, as we stated in the last slide. And we have to remember that justified wages is dealing with the actual cash versus cash equivalents, making the gross amounts more necessary for the case. If justified wages was dealing with cash equivalents in terms of like investments, but investments and not short-term investments, they're dealing with actual cash. The cash that they're using is short-term, it's not long-term, which is why it would not be a part of the net cash flows. So for this one, the answer would simply be gross cash flows based on the relevance that they're dealing in actual cash, not cash equivalents.
All right, so the second question of the case asks how the cash received should be paid, and how it should be classified. So we found that there were different ways that they received payments during this case when selling to WTD. So we decided to look at excess of purchase price over fair value, the repurchase of employee stocks, employee compensation, sale of common stock to the company, and issuance of Series E preferred stock. So we also just went on ahead and listed the codifications that will relate to each one. So the codification One discusses how to account for the excess of the purchase price over fair value for the employees. The second codification will discuss how to account for the repurchase of employee stocks. And the third codification is, talks about how to account for employee compensation. All right. So we're going to first visit ASC 7, 18, 20, 35, and 7. We'll pull it up for you guys so that you can read along with us and how we came to our answer. All right, so ASC 35-7 talks about the repurchase or cancellation of the shares, which is something that happened during the case. So the amount of cash or other assets transferred or liabilities incurred to repurchase an equity award shall be charged to equity to the extent that the amount paid does not exceed the fair value of the equity instruments purchased at the repurchase date. Any excess of the repurchase price over the fair value of the instruments repurchased shall be recognized as additional compensation costs. So that right there told us that for the excess of purchase price over fair value, the 2.6 million, that's going to be compensation. All right. And then the next one we'll be talking about, these codifications are pretty much linked to 230, 10-45-14, and -15A. We'll go to those as well. And we'll scroll to that again for you guys so you can read along with us. Okay, so 45-14 basically talks about cash flows from financing activities. So proceeds from issuing equity instruments and proceeds from issuing bonds, notes, and things of that nature. And so that's how we determine that the cash flows from purchasing from issuing the shares would be considered a finance activity, and that's where you would locate that on the statement of cash flows. And then for section 15A, that discusses the outflows. So when they paid any of the dividends or anything, that would also go into the financing activities, but that would just be subtracted from them. All right, so we can just go ahead and just show you our answer. So just to revisit, based on the codification, so the excess of purchase price over fair value will be recorded as a compensation. Repurchase of employee stocks will be recorded as financing activities. Employee compensation would be reported under operating activities. Sale of common stock to the company sold it to would be reported under our financing activities, and the issuance of the preferred stock would also be under our financing activities. All right.
Okay. And then for question 3, we have, does the accounting analysis or conclusion change for each of the questions also above when analyzed in accordance with IFRS? Yes, accounting analysis, changes when in accordance with IFRS. The $10 million received by the company, which is also paid out to employees, is a representation of financing activities on the statement of cash flows. To go a little bit more in depth with that, so when we're purchasing common stock from employees, we have to consider that as an investment activity because the company's ability to either gain or lose from that transaction. But since in this case, since we are getting money received from the purchase of common stock, it will be treated as a financing activity. So in this case, for the answer for our question 3, we will treat it as a representation of financing activities. And to go back to tie everything around over the presentation, we just want to really emphasize our points on the pre-assessment and all of those questions. We hope to have answered all of them, or at least give you more insight on all of those questions for the pre-assessment as well.
All right. And we also decided that we were going to attach our, however we link it, they link it to Blackboard for us. It's going to be a crossword puzzle. So you basically will use the definitions of the words. You'll be able to go through the PowerPoint and use that to answer the crossword for the vocab words that we'll also give to you guys. And you can just use that for further review in case it, comes up on a quiz or a final exam. So we just want to thank you all for watching and hope that you guys gained a lot of information on the statement of cash flows and learned how to basically link the codification to answering the questions, because that is extremely important in this class and something that we have had to learn how to do. Thank you for your time. All right, good morning, class. So as y'all remember, last week we went over the statement of cash flows. So today we're just going to do a little review and see if you guys remember which accounts go to which section. Did you guys review the PowerPoint?
Yes.
Yeah.
Did you review your class notes?
Yes.
All right, here we go. All right, so where would number one go? Depreciation.
I'm gonna say operating.
What do you say?
Operating.
Operating? Okay, so y'all want to just put one, or y'all want me to put
Probably put one.
Probably cool.
We'll do both. Why not? We'll review it later. You take a picture of the board after. What? Okay, go ahead. Okay, so number two, where would you put the investment?
Operating.
Operating.
I'll
Yeah,
get that.
I say operating.
Okay, y'all. Oh, two. Oh. All right, where would you put the accounts receivable? Which activity?
Operating.
All right. Where would you put your sale of property?
Ooh, I want to say. I don't want to say. I think. Not think. I know. Investing. I feel it's investing. What do you think?
Okay.
Kevin?
Sale of property. What do you think?
I think that's the only one that makes sense. Investing.
Why? I can tell y'all study. Okay, look at y'all. Okay, number five, buying intangible assets. Which activity would you put that under?
Investing. For sure.
Investing? Okay, cool. We learning. Okay, capital expenditures.
Investing.
Investing. All right. Man, we're going to get some financing on the board. All right, number seven, dividends are common.
That would be finance.
That's okay. Look, we got something. Y'all study. Yes. Number eight, y'all did that crossword puzzle.
Yeah.
Number eight, purchase of treasury stock.
Financing.
Sorry. Financing? Okay. Purchase of equipment?
That's investing.
Yeah.
That's investing. Okay. And where would you put your cash collected from your customers?
And you're operating.
In operating? Alright. Alright, so just so y'all remember, our statement of cash flows has three components. We got cash coming from different areas. That's why we have to divide into these different activities. So operating activities is going to be first. And then you're going to have your investing activities and your financing activities. Remember our target example? Alright, thank y'all for participating.